Hey everyone, welcome back to Corporate Decoder, the place where we decode the most interesting corporate filings. This year's report from DoubleLine Yield Opportunities Fund is packed with, let's just say, some very specific financial instruments and a whole lot of risk. So buckle up because we're diving deep into their latest annual report, looking at where their money is and more importantly, where it is going. The fund's entire purpose is to seek a high level of total return with a strong emphasis on current income. But as you'll see, it aims for this through some pretty complex and, frankly, risky avenues. Ronald Reddle, their chairman, sounds pretty optimistic, talking about their time-tested process and confidence in taking advantage of future opportunities. He mentions their commitment to delivering attractive risk-adjusted returns. We'll see if the numbers back that up. This is where things get juicy. For the year ending the 30th of September 2025, the fund actually outperformed its benchmark, the Bloomberg US Aggregate Bond Index. They chalk this up to a substantial overweight to securitized credit assets, like collateralized loan obligations and commercial mortgage-backed securities. They say these provided high interest income and benefited from credit spread tightening. The catch though, agency mortgage-backed securities detracted from performance due to interest rate volatility. Here are the key performance figures for that 12-month period. The total return based on net asset value was 6.72%. That sounds good, right? But then look at the total return based on market price, which was actually negative 0.32%. This tells us the market price of their shares dropped even as the net asset value, what the underlying assets are worth, went up slightly. That is a crucial distinction for closed-end funds like this. Let's look at the growth of a $10,000 investment table. It really paints a picture. Over 5 years, the total return based on net asset value was 5.00% annualized. However, the total return based on market price, which is what you as an investor actually experience, was 5.12% annualized. This slight outperformance of market price over net asset value is a bit unusual, especially considering our earlier finding of a negative market price return for the last year. The benchmark, the Bloomberg US Aggregate Bond Index, had a negative 0.45% annualized return over 5 years. So they did beat the benchmark, but the market price performance is something to keep an eye on. Now, let's get into the nitty-gritty, the schedule of investments. This is a massive list of everything the fund owns. As of the 30th of September 2025, we see over 20% of their assets are in bank loans, a whopping 22.2% in non. Agency commercial mortgage-backed obligations, and another 19.9% in non-agency residential collateralized mortgage obligations. That is almost 62% of their holdings in these very specific and often risky types of securities. Digging into non-agency commercial mortgage-backed obligations, we see many listings like RIT Trust with terms like 1MO term, SOFR plus 2.79%, 2.79% floor. This language is super technical, but it generally means these are loans tied to commercial properties, and their interest rates adjust based on a benchmark, like in this case SOFR, plus a set spread. The floor means the interest rate won't drop below a certain point. Then we have non-agency residential collateralized mortgage obligations. We see familiar names like Fannie Mae and Freddie Mac securities, but also many other complex trust structures. These are essentially securities backed by pools of mortgages, and the fund is holding different tranches, which carry varying levels of risk and potential return. Moving on to us corporate bonds, we see a lot of holdings in companies that sound like they are in industries with cyclical or higher risk profiles like American Axle and Manufacturing Inc., Clear Channel Outdoor Holdings Inc., and a significant chunk in Staples Inc. The rates on these are often in the high single digits or even double digits, clearly indicating they are considered high yield or junk bonds. Let's jump to the statement of assets and liabilities as of the 30th of September 2025. Their total assets are over $937 million, but look at the liabilities over $163 million. Notably, they have a loan payable of $130 million, showing they are indeed using leverage, as flagged in their risk section. This is a big chunk of their capital structure. This loan payable is substantial. It is over 16% of their total assets. The interest rate is variable, tied to SOFR plus an applicable margin, and they also pay a commitment fee. This leverage amplifies both potential gains and potential losses. Now for the statement of operations for the year ended the 30th of September 2025, total investment income was over $83 million, mostly from interest. But then look at the total expenses, nearly $22.4 million, before accounting for waived fees. That is a significant cost of doing business. They did receive waivers from their investment advisory fees, which is a small bit of relief. The net investment income for the year was over $60 million. That is good, but it is partially offset by a net realized and unrealized loss on investments of nearly $10.9 million. So, while they earned income, the value of their investments decreased over the year. Looking at the statements of changes in net assets, we see a net decrease of over $14 million for the year ended the 30th of September 2025. This follows a massive increase of over $65 million in 2024. It highlights the volatility and the cyclical nature of their performance. The financial highlights are a great summary for the year ending the 30th of September 2025. The net asset value per share started at $16.38 and ended at $15.95. The total return on net asset value was 6.72%. But remember what we saw earlier about the market price. The total return on market price was actually negative 0.32%. This again shows that while the fund's assets might have grown in value, the market wasn't willing to pay as much for the shares on the exchange. The net assets at the end of the year were just under $774.3 million, down from nearly $788.6 million the previous year. The ratio to average net assets for expenses, including interest expense, was 2.89%. That is a hefty chunk just to keep the fund running, especially considering this is before any potential advisory fee waivers, which were minimal. Now, the notes to financial statements are where we find the real context and explanations. Under significant accounting policies, we see they use fair value accounting and have a hierarchy for valuing assets. It breaks down into Level 1, quoted prices in active markets, Level 2, observable inputs, and Level 3, unobservable inputs. A significant portion of their assets, over 74%, are Level 1 securities exempt from SEC registration, meaning they are private placements and less liquid. This table shows how their investments are categorized by valuation input. A massive $877.8 million is in Level 2, meaning they rely on observable market data, not just direct market prices. However, over $2.3 million are in Level 3, meaning they use significant unobservable inputs. This implies some subjective judgment in their valuations, which can be risky. This is a critical part of any investment report. The fund faces many risks, and they are laid out in extensive detail. We're talking market discount risk, limited term and tender offer risk, leverage risk, which they openly admit amplifies risk, and costs and liquidity risk. They invest heavily in below investment grade debt, which is considered speculative and has a higher default risk. They also invest in assets that are complex and potentially illiquid, like mortgage-backed securities, collateralized loan obligations, and loan investments. They spend a lot of time on mortgage-backed securities risks. They detail credit and market risks, prepayment and extension risks, and the volatility of specific types like interest, only and principal, only securities. They also highlight how housing market downturns and rising interest rates can severely impact these investments. The risks associated with commercial mortgage, backed securities or CMBs also get a detailed explanation, along with the complexities of risk retention, tranches, and potential legal hurdles. Then there is loan risk, a huge section. They highlight risks related to agent intermediaries, highly leveraged transactions, and investing in stressed or defaulted borrowers, all very speculative. They also mention covenant-light loans, which have fewer restrictions on borrowers, increasing the risk for lenders. They even warn about lender liability and the fact that some loans may not even be considered securities, meaning less legal protection. Let's talk about the people managing this whole operation, Jeffrey E. Gundlach and Jeffrey J. Sherman. They've been with the fund since its inception. Interestingly, neither of them owns any equity securities in the registrant itself, which could be seen as a sign of alignment with the shareholders or a lack of personal conviction in their own fund. This policy document outlines how DoubleLine votes shareholder proxies. They generally vote in favor of proposals that protect shareholder rights and enhance economic value. But there is a lot of case-by-case analysis, especially on complex issues like executive compensation or ESG factors. They do use a third-party service, Glass Lewis, to help them analyze these proposals. Interestingly, they have a whole section on their privacy policy. They emphasize they do not sell customer information to third parties, which is good. They collect personal identification, contact, family, professional, and financial information. They mention using web analytics tools like Google Analytics and Adobe Analytics. This section summarizes changes since their last annual report. What is striking is that there have been no material changes to their investment objective or principal strategies. They continue to focus on seeking a high level of total return with an emphasis on current income, investing heavily in below investment grade debt and unrated instruments. They may invest without limit in securities of foreign issuers, including emerging markets, and may invest up to 30% in emerging market countries. They also explicitly state there are no limits on the duration of the fund's portfolio and that they may construct a portfolio with negative duration. They explain their use of leverage, currently through a $225 million revolving credit facility. They mention that the fees for asset management are based on total managed assets, which include leverage. This creates an incentive for them to use leverage, potentially conflicting with shareholder interests. They lay out some complex calculations to illustrate the impact of leverage on assumed portfolio returns. This is a recurring theme. They openly state that shares of closed-end funds frequently trade at a discount to their net asset value. For their fund on the 30th of September 2025, the market price was $15.08 while the NAV was $16.07. That is a 5.45% discount. They explain this is common, but the board monitors it and may consider share repurchases or tender offers, but can't guarantee they will. So putting it all together, DoubleLine Yield Opportunities Fund is playing a high-stakes game. They are clearly chasing yield by investing in complex, often risky and less liquid debt instruments, particularly securitized credit and below investment-grade loans. While they did outperform their benchmark on an asset value basis this past year, the fact that their market price actually decreased while the NAV rose is a significant red flag for shareholders. It means the market is valuing their complex holdings less than the fund's own valuation suggests. The sheer volume and complexity of the risks they outline, from loan defaults and interest rate hikes to geopolitical instability and operational failures, are extensive. Their heavy reliance on bank loans, non-agency mortgage-backed securities, and clause means they are deep in sectors that are highly sensitive to economic downturns and interest rate fluctuations. The fact that they state there are no limits on the duration of the fund's portfolio, and they may construct a negative duration portfolio, is a bold strategy, but one that carries immense risk. Their dividend reinvestment plan and active use of leverage, while potentially boosting returns in good times, also amplify losses in bad times, and the associated fees eat into returns. The significant discount between market price and NAV suggests investors are skeptical about the current valuation or future prospects. While they may have navigated past periods successfully, the current economic climate with rising interest rates and persistent inflation makes their strategy particularly susceptible to headwinds. In conclusion, this fund is not for the faint of heart. It offers the potential for high current income, but that comes with a substantial appetite for risk complex instruments, and the ongoing challenge of its market price trading at a discount to its underlying asset value. It is a tightrope walk, and whether they can keep their balance through market volatility remains to be seen. Alright, that is our deep dive into DoubleLine Yield Opportunities Fund's latest filing. What is your take on these complex holdings and their strategy? Do you think their bet on securitized credit is paying off, or are the risks too high? Let me know your thoughts in the comments below. If you found this analysis valuable, please hit that like button, subscribe for more corporate insights, and don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, and we'll see you in the next video.